Hello there, welcome to another video on investing on the stock market. Today we're investing in banks. Now if you like what you see, hit subscribe, drop me comments if you have any questions whatsoever. So we're doing a bank showdown today and we're going with JPMorgan, Bank of America, Wells Fargo, Citigroup and Morgan Stanley. Now I've gone with all the big US banks because they're the most stable, well-known and best run. And they also have a lot lower leverage than the EU banks, so there's less risk. So these are some great stocks. I think everyone should own at least one bank or financial stock. They move sort of together with the economy. If the economy is doing well, interest rates are going up, banks are going to benefit from that, and that's what's happening now. Most of these banks have all recovered from the financial crash back in 08-09. So they're pretty low risk defensive stocks. Now the numbers have changed up. So we're doing 5-year revenue growth, net interest margin, which is the difference between the interest the bank is paying on their loans, so the money they're borrowing, versus how much they're making from that money, right? So they're borrowing money and investing it and making money. So the difference between that is net interest margin. Leverage is how much debt a company has compared to equity. So of all the money the bank has under management and has invested, how much of that is borrowed money, so debt. So the lower the number, the better. For this one, the higher the number, the better. Return on equity, which is how much money the company is making with the money you give them as an investor. Return on assets, which is how much money on average the bank is making from all the assets it's making money from, which is trillions of dollars. And then dividend yield on top, because pretty much all banks pay a dividend. Now, I'm personally invested in JPMorgan, but they're all great banks. The numbers are going to be very unique because banks are just that. They are the most unique companies in the world because they make money from having money. That's all they do. So the numbers are going to be small, the differences are going to be tiny, but keep in mind, these banks, every single one of them, manage trillions of dollars under management. These banks have more money than any other company or any country. So a small difference in net interest rates or leverage or return on assets, just a 0.05% change can make up a big difference and mean billions of dollars extra in revenue. So keep that in mind. I think the biggest JPMorgan manages about 2.5 trillion and it goes below 2 trillion down to Morgan Stanley. The banks are in the order, I think in size, it's at least JPMorgan first, Bank of America, and then maybe the rest is in the right order. So sit back, relax and enjoy this stock showdown. So let's get to it. Now we're starting with JPMorgan, which is the largest bank in the US, and I think it's the 9th or 8th largest bank in the world, coming in at only 2.6% revenue growth, minus 5.3% net interest, 11.63 leverage, 9.86 return on equity, 0.89% return on asset, and then it pays an annual yield of 2.02% dividend. Moving on to the second biggest bank, it's almost as big as JPMorgan, Bank of America. Now, as I said in the beginning of the video, keep in mind that these numbers are going to be lower and a bit different than most traditional companies because banks operate in a different way and in different cycles. So we got 7% revenue growth, negative 3.9% net interest, 9.32% leverage, 6.83% return on equity, 0.74 return on assets, and then 1.66 annual dividend yield. Right, now moving on to Wells Fargo, a very old, well-established bank. Of course, there's been some bad news recently about the bank, but it's still a sound investment, coming in at 2.9% revenue growth, negative 2.9% net interest, 10.75% leverage, 11.53 return on equity, 1.06 return on assets, and then a solid 3.06% dividend yield. Moving on to Citigroup, another massive bank, 2.7% revenue growth, almost the same as JPMorgan and Wells Fargo. It's pretty even here. Negative 10.4 net interest rate, very important number, very bad for Citigroup. 10.15 leverage, negative 4.16 return on equity. That's a really damning number. Negative 0.44 return on assets, so they're not getting much done with their current assets under management and the equity you give them, keep that in mind. And 1.82% dividend yield. Right, now moving on to our last bank, MS, ticker symbol aka Morgan Stanley, a bit of a smaller bank, 32% revenue growth. Now this number, I will say, I didn't find it from Morningstar, which is my source for all the other numbers. So do keep that in mind that I'm not 100% sure about this one. 12.37% leverage, quite high leverage compared to Bank of America, for example. 8.13 return on equity, which is decent. 0.67% return on assets, hello there. And then 1.84% dividend. So, looking at our numbers, our winner for revenue growth is clear. It's Morgan Stanley over here. Winner here is also Morgan Stanley, but I'm not 100% sure about this number. For leverage, it's definitely Bank of America, very important number here. Return on equity, by far Wells Fargo. Then it looks like Wells Fargo is always the winner, also the winner for return on assets. And then the highest dividend goes to Wells Fargo. The dividend doesn't mean it's a great investment, but it is icing on the cake. So looking at the numbers, it's pretty even. I would say looking at the numbers is important, but also look at the management, the brand, and so on. So Wells Fargo going for the victory here, with Morgan Stanley coming in at second, at least with these numbers. Now, of course, keep in mind, numbers are not everything. I'm personally invested in JPMorgan, so keep that in mind. And you know, do your own research. But I think banking is one industry you should be in. It's very important for the economy, and they go in cycles. And when the economy does well and interest rates are rising, banks will do well. They're also quite defensive stocks. You know, they're very safe. They don't move a lot when there's market correction. But when there's big crashes or depressions in the economy, the banks really suffer. And then they take a while to recover. But I definitely think you should own a bank. And if you're going to own a bank, you might as well own the US banks, by far the best operated one. And here are the big five. And of these, looks like Wells Fargo has the best numbers. So as always, I hope you enjoyed this video. Let me know what you want me to do next. It's probably going to be either aerospace and defense or video games. As always, see you in my next video.